As we look at the charts right this second, NIO Inc. is trading at exactly $5.50 per share, down a painful 25 cents or 4.35% on the intraday session. If you are watching the ticker tape flash red today, you might be feeling that familiar tightening in your chest, the specific anxiety that comes when the market does the exact opposite of what logic dictates it should do. We are seeing a classic sell the news event unfolding in real time, and the volatility we are witnessing on the order books right now suggests a massive tug of war between retail hope and institutional skepticism. The expectation going into this morning was palpable. Investors were looking for a breakout, a validation of the turnaround story that has been promised for years. The reality, however, is a sharp rejection at key resistance levels, leaving many holding the bag on what was supposed to be a celebratory day. This disconnection, where the company posts record deliveries yet the stock price crumbles, is the single most important narrative to understand today. It forces us to ask, is the market wrong, or is there a deeper rot in the financials that the headline numbers are hiding? Let's strip away the noise and look at the raw movement we are seeing on the screen. The stock opened this morning with a gap down, immediately signaling weakness, and has spent the last few hours grinding lower, failing to reclaim the volume-weighted average price. We are seeing heavy selling pressure on every attempted bounce, a hallmark of institutional distribution. This isn't just retail panic, this is calculated exiting. When you look at the flow on platforms like Interactive Brokers trading terminals, you can see large block orders hitting the bid, absorbing the liquidity provided by smaller traders who are likely buying the dip on their Robinhood app. The volume today is surging past the 10-day average, indicating high conviction from the sellers. This is not a low-volume drift, this is an aggressive repricing of the asset. The $5.50 level is psychological support, but if we break below this, the technical damage could invite further downside testing of the $5.20 region. It is brutal, it is bloody, and it is exactly the kind of price action that separates the emotional gambler from the calculated analyst. To understand why this is happening, we have to look at the immediate catalyst, the Q3 earnings report that dropped just prior to this movement. On the surface, the numbers looked solid. Revenue came in at $3.06 billion, up nearly 17% year over year. They delivered over 87,000 vehicles, a record for the company. Margins improved to nearly 14%. If you were just reading the headlines on your Fidelity mobile app, you would think the stock should be up 10%. But here is the contrarian take that the market is pricing in. The growth is expensive and the guidance was soft. The market is forward-looking, and right now it sees a company that is increasing sales but still burning cash at an alarming rate in a geopolitical environment that is becoming increasingly hostile. The expectation was that NIO had solved its cash burn problem. The reality is that they are merely managing it while facing a massive wall of tariffs in Europe. This divergence is why we see the stock down 4% despite good news. Let's pause for a second. Comment below with your average buy-in price for NIO. Are you averaging down today, or are you waiting for the dust to settle? I want to see where the community sentiment is at right now. Now, let's talk about the broader trading landscape because how you access this market matters. If you are a retail trader using Robinhood stock trading features, you might be tempted to use Robinhood fractional shares to nibble at this drop, thinking it's a steal. The interface makes it easy to catch a falling knife, and the gamification of Robinhood investments can sometimes mask the risk of these high-beta Chinese ADRs. On the other hand, if you are using Schwab Intelligent Portfolios or a similar robo-advisor, you likely have zero exposure to this name because the algorithms that drive intelligent portfolio strategies are designed to avoid this exact type of idiosyncratic volatility. There is a reason for that. Smart money, the kind managed by Fidelity Wealth Management or held in conservative Fidelity mutual funds, typically steers clear of companies that are subject to regulatory whiplash unless they are part of a broader emerging market basket. However, for the active trader using Interactive Brokers platform, today is a playground. The volatility allows for sharp scalps, and the Interactive Brokers fee structure favors high-frequency execution, which is necessary when navigating a stock that moves 5% in a single session. We need to discuss the elephant in the room, the Onvo Long L60. This was supposed to be the savior, the high-volume vehicle that allowed NIO to stop being a niche luxury player and start competing with Tesla's Model Y on a mass scale. The data shows they have delivered over 20,000 units of the L60 in just 100 days. That is impressive execution. It proves that the demand is there. However, the market is worried about cannibalization. Is Onvo stealing sales from the higher-margin NIO brand? The price point is lower, which means they need to sell significantly more units to generate the same profit. It is a volume trap. If they miss volume targets, the margins collapse. We are seeing a shift in the business model from luxury lifestyle to mass manufacturing grind, and that transition is messy. It is fraught with execution risk, and Wall Street hates uncertainty. The drop to $5.50 today reflects the fear that NIO is entering a price war it can't afford to win, unlike Tesla stock, which has the cash reserves to bleed out the competition. Speaking of competition, the comparison to Tesla stock is unavoidable, but increasingly flawed. Tesla is a software and energy company wrapped in a car manufacturer. NIO is a lifestyle brand trying to be a tech company. The NVIDIA stock rally that we've seen over the last year has lifted many boats in the AI sector, and NIO tries to draft off this by touting its autonomous driving chips and ADAS, autonomous driving as a service. But investors are getting savvy. They know that buying NVIDIA stock is a play on the chips themselves, whereas buying NIO is a bet that they can actually deploy that tech effectively in a regulatory minefield. The correlation between NIO and the broader tech sector is breaking down. We are seeing capital rotate out of speculative EV plays and into safer, cash flow positive tech giants like Apple stock. Even Apple stock, with its muted growth recently, offers a safety profile that NIO simply cannot match. This rotation is draining liquidity from the EV sector, leaving stocks like NIO vulnerable to these violent downside moves. Let's look at the macro picture, specifically through the lens of the Chinese economy. The stimulus packages announced by Beijing in late 2024 and throughout 2025 were expected to light a fire under consumer spending. The expectation was a V-shaped recovery. The reality has been a long, U-shaped slog. Consumers in China are saving, not spending, and when they do spend, they are looking for value. Hence the success of the Onvo brand over the premium NIO models. This macroeconomic headwind is massive. It creates a ceiling on the stock price. No matter how good the company performs, if the Chinese consumer is essentially on strike, the upside is capped. Furthermore, the EU tariffs of roughly 31% on NIO vehicles are a devastating blow to their global expansion plans. NIO built its entire growth narrative on the idea that it would conquer Europe. That door is now half closed. The market is repricing the stock to reflect a China-only or China-mostly future, which is significantly less valuable than a global powerhouse. The financing aspect is another layer of this bearish cake. NIO has raised capital repeatedly, diluting shareholders. If you hold Fidelity IRAs or use SoFi Active Investing, you have to be conscious of dilution. It is the silent killer of returns. Every time NIO issues convertible notes or secondary offerings to fund its battery swap stations, your slice of the pie gets smaller. SoFi investing platforms often attract younger investors who look at the nominal price, $5.50, and think it's cheap. But market cap relative to earnings potential is the real metric. NIO is still valued at billions of dollars despite not making a profit. The cheap argument is a trap. You have to look at the enterprise value and the debt load. Interactive Brokers stock trading forums are filled with sophisticated retail traders analyzing the bond yields on NIO's debt, and right now the credit markets are signaling caution. Despite the gloom, there is a path forward, and this is where the contrarian opportunity lies. The battery swap network is a moat. No one else has it. If NIO can license this technology or make it an industry standard in China, the economics change overnight. It transforms from a car company to an energy infrastructure company. Think of it like Tesla stock and its supercharger network, but even more integral to the vehicle's operation. This is the long-term play. If you are using Schwab Intelligent Portfolios or have a long-term horizon in your Fidelity brokerage account, this is the only thesis that makes sense. You are betting on infrastructure, not just metal and rubber. The recent partnership deals for battery swapping are